UK inflation held at 2.8% in May, below the 3% the market expected, and below the heights that seemed inevitable when Iran choked off Strait of Hormuz oil supplies in March. The bottleneck is not in the headline, it is in what the headline is concealing from the relief trade. Services CPI accelerated to 3.7% in May, up from 3.2% in April, a jump that runs directly counter to the idea that the inflation impulse is fading. Motor fuel costs were up 25% year-on-year, according to the ONS. Transport prices as a whole jumped from 4.5% to 6.8%. Food prices fell, pulling the headline lower, but food prices are a lag indicator of supply chain cost, not a structural disinflation. The ONS chief economist noted that raw material costs continued rising, led by chemicals, while factory gate price increases slowed only because domestic car production costs fell. That is not broad disinflation. That is a narrow offset in one sector masking acceleration in another. The pound fell on the print, not the response of a market that read this as unambiguously good news. The FTSE 100 edged lower, with consumer-facing names under pressure. Marks & Spencer fell 3.4%, joined by Rightmove and Sainsbury's. Rate-sensitive financials held up. Barclays rose 2.5%, Lloyds and NatWest gained, because the market repriced a Bank of England hike as less likely tomorrow. That repricing is the decision variable, and it may be premature. When the Strait of Hormuz closed in March, analysts warned of an inflation shock that would force the Bank of England into multiple rate hikes. At the peak of that fear, money market traders were pricing as many as 4 rate increases through 2026. The 2-year gilt yield hit 4.7%, nearly a full percentage point above the BoE's actual base rate of 3.75%. Since then, Brent crude has fallen below $80 a barrel on Iran peace deal hopes. That oil retreat is doing work in the headline CPI number. But it is not doing work in the parts of the economy that matter for persistent inflation: services, labor costs, and household energy bills. The off-gem energy price cap rises 13% in July. That single change will mechanically push headline CPI higher, regardless of what oil does between now and then. Lindsay James at Quilter stated it directly. The benefits of the U.S.-Iran resolution will not be immediately felt. Food prices are likely to see greater impact from higher costs of production, as the cost and availability of fertilizer, energy, and transportation remains restricted until the Strait of Hormuz is fully opened again. The Hormuz Strait reopening is still a process measured in months, not days. Tankers are not moving. Infrastructure restoration takes time. Luke Bartholomew at Aberdeen captured the structural position. The bank will want to remain vigilant to the impact of higher household energy bills on broader inflation expectations. The market's pivot from 4 hikes to hold is not wrong in isolation. The near-term CPI data supports caution on hiking. The assumption underneath that pivot is that the soft May print represents a trend. Services at 3.7% challenges that assumption directly. If the July energy cap lifts the headline back above 3% while services stays elevated, the inflation peaking narrative breaks, and the gilt market, which has been buying duration on rate hold expectations, faces a reversal. The Bank of England meets tomorrow with 2 named camps pulling in opposite directions. Aberdeen's Luke Bartholomew said the BoE will hold, and noted it is plausible speculation begins to turn once again to when the bank will cut rates again, not hike. That is a dovish read. The soft CPI gives the MPC cover to stand pat and signal patience. But the gilt market has not fully accepted that framing. 2-year yield sat at 4.7%, implying 3 to 4 hikes priced in, before Trump's Iran comments knocked them to 4.55%. MUFG research said today's soft CPI weakens the case for BoE hikes. Bloomberg reported gilts climbing on the data as investors backed caution on rate hikes. Those are not the same position. MUFG is saying the hiking case is weaker. The gilt move says hold is confirmed, but cuts are not yet priced. Aberdeen says cuts are back on the table. Governor Bailey, according to Aberdeen's Matthew Amos, did not sound like a man feuilleting to rise rates 3 times by September. That is a qualitative read on communication, not a commitment. If the BoE tomorrow signals a clean hold with no residual hawkish language, the gilt market's 4.55% 2-year pricing implies further unwind downward, which would lift rate-sensitive FTSE names and gilts. If even 1 or 2 MPC members vote to hike, citing services at 3.7% or the July energy cap risk, the market reads the committee as more split than priced, and the relief trade unwinds.
The counter risk is genuine and pool-grounded. Oil's fall could continue through the Iran deal signing, delaying the July cap impact and giving the BoE the clean hold it wants. But the key variable is not tomorrow's vote. It is whether the July inflation print post-energy cap forces the MPC back into a hiking conversation the market has already declared closed. Holders of gilts and rate-sensitive UK equities should watch the MPC vote split, not just the headline rate decision, as the first read on whether the committee is as unified as markets assume. Watchers considering entry into UK rate-sensitive names should wait for the July off-gem cap to pound through CPI before positioning on the rate cut thesis. The gap between now and August is where the relief trade is most exposed. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.